Have you heard of the big, beautiful bill? Well, whether you think it's beautiful or not doesn't matter. We're talking today about the standard deduction as well as another deduction that you will get, and it could save you significant money. And so we think this would be a really good episode for you to learn a little bit about this new bill.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement podcast. We are excited to be talking with you today and going through a topic that I think a lot of people have questions about, and it is around the newly passed tax bill called the Big Beautiful Bill. I think that's what it's called.
That's it.
And I always like to say this: whether or not you personally think it's big and beautiful, that's neither here nor there. We're just going to talk about some concepts and things that we're seeing in real practice. And when we talk about taxes and we talk about how we help our clients, there is no one better to help us in that than to bring on our own in-house tax strategist, Taylor Wolverton. So Taylor, thanks for coming on and chatting with me and Merce.
You're welcome.
So I was in an appointment the other day, and then Merce actually was just in another one with you. And quite honestly, you're showing people things right now around this new bill that honestly I didn't even understand how it worked. And we've been telling our listeners that we're going to come out and talk about some of these things. And I felt like me and Merce were like, it's a little overwhelming to come on here and talk about every single thing about this new bill. So we thought, as we see things in real life practice, how we might be able to come on and explain it. But I do believe, though, that what we're seeing you show people is extremely impactful. And I don't think people know about it. I mean, they find out once you tell them, but I don't think they know what's going on. I mean, Merce, what's your impression about what you've gotten in the couple that you've sat in on?
Yeah, so I think the topic that we're going to go over today is brand new to everyone. I don't think it's something that's ever been done before in the tax code. So very impactful. I learned in that meeting a couple of things that we're going to share with you, and I know the clients did as well. And by the end of it, you're like, man, if I don't have someone looking at this for me, then I could be making some potential tax issues for myself. So very, I think, powerful. But yeah.
All right, well, let me just set this up real quick, and then Taylor, I'm going to ask you to kind of walk us through a scenario. But here's the scenario, and I'm going to give, I'm not disclosing every personal detail here, but ultimately, we met with a client. We were doing what we do in the second half of the year, which is a tax strategy meeting. So in this tax strategy meeting, what Taylor does is she looks at last year of how that worked, and then basically says what's going to happen this year. And a big part of that conversation is, are you putting enough away in taxes? Are you putting too much away in taxes? Do we need to adjust withholding? Do we need to adjust quarterly tax payments? Whatever that might be. And in this particular family scenario, they last year and when they filed their taxes, they owed money. And because of some of the new parts of this bill, what she was showing them is, in fact, with no changes of what they're doing, they're actually going to get back now a sizable amount of money. So what I did is I got through with that meeting and I went, Taylor, that is going to be a really good podcast. And I want you to kind of walk us through that exact scenario so that people understand it. Because right now we're sitting here in the latter part of the year and people are going to be getting ready to do their taxes. Well, there's maybe some opportunities there that they could take advantage of. And so, Taylor, if you don't mind, could you kind of set up and kind of walk us through almost like you would be walking a client through this situation and explain kind of a step-by-step of what is the difference today compared before this bill passed?
Yes, yeah. The two things that we're going to be talking about and looking at specifically in this example that have changed as a result of the new tax law is the first one is that the standard deduction was updated for everyone. Everyone who files a tax return is eligible to take the standard deduction. The majority of people do take the standard deduction. The standard deduction is the first amount of income that you don't have to pay tax on. And depending on if you're below age 65 or over age 65, your standard deduction is a different amount, and also your filing status also is a determining factor in what exact dollar amount your standard deduction is going to be. But the new tax law increased for those filing jointly, increased the standard deduction by $1,500, regardless of your age. And if you're filing single, it increases your standard deduction by $750, regardless of your age. So for everyone, the increase in standard deduction, everyone taking the standard deduction, I should say, is going to be impacted. And an increase in a standard deduction is an increase in tax-free income, which means less taxes paid for the year. And then the other thing we're going to look at, which is another update in the tax law, is for those over the age of 65, they're eligible for an additional up to $6,000 deduction. So again, $6,000 more in tax-free income this year. The standard deduction is quote unquote permanent. What permanent means when it comes to tax law, I don't really know. But the other senior deduction for the $6,000 if you're over age 65, that is set to go from 2025 through the year 2028. So that one we'll see here for the next few years, but it's not permanent. So I'll start sharing my screen here.
Yeah, Taylor, while you're pulling that up, I wonder if off the
Mhm.
top of your head, let's say the tax reform or the tax bill didn't go through, the standard deduction was scheduled to go down pretty significantly, wasn't it?
Yes, it was, I believe it was about to be cut in half or somewhere close to being slashed in half around. Yes.
Right. So it's staying in place, but also being an increase is definitely going to be a positive for a lot for all taxpayers that are
Yeah,
taking the standard.
And real
definitely.
quick, I want to say this too, just because I didn't say this a little bit earlier. Um, Taylor is sharing her screen. I will tell you that if you watch this podcast, you can watch it on Spotify. Spotify allows you to be able to watch this and see it. We also have this on YouTube as well, so you can watch it on YouTube. If you're walking right now or you're driving and you just hear it, that's okay. But I want you to know you can come back and either watch it on Spotify or watch it on YouTube and actually see this, because I think this is to me, one of the most impactful things is what she's about to walk through, what's on the screen.
Yes. Okay. So what we are looking at right now is, in a way, a recreation of a 2025 tax return. So this is obviously forward looking for the current year, 2025. And I'm just going to walk through, in this example, this is a married couple. They are filing jointly. They are also both over the age of 65. That's an important factor to know, because if you're over the age of 65, you have a different standard deduction, and you're also eligible for that other deduction that we were talking about as well. So I'm just going to walk through some of the sources of income that we're expecting this couple to have in 2025. So first thing starting out that we're looking at, they have some interest. Interest comes from money market accounts, CDs, savings, things like that generate interest. Also some investments do as well. So we're estimating around $7,000 in interest for 2025. They also have some dividends from their investment accounts. We're estimating around $1,000 in dividends. And then they're also both taking distributions from their traditional IRAs. Anytime you take a distribution from your traditional IRA, it's fully taxable. You'll pay tax in the year you take a distribution. So this couple, they have this year, by the end of 2025, expecting around $60,000 in IRA distributions. And then they also have some pension income, around $30,000 a year between the two of them. So that's another source that we're expecting this year. And then they also have Social Security. So we have around $63,000 in Social Security this year as another source of income for them. One place that's been kind of confusing around the new tax law for a lot of people is whether Social Security taxation changed at all. So I want to be clear on this point. The way Social Security is taxed has not changed at all for the new tax law. That is still the exact same as it was last year, the year before that, the year before that. What happens in this couple situation is they pay tax on 85% of their Social Security. So that's the way that it was last year. That's not going to change.
Can we take
So
a
what we're
second to
yeah,
clarify that one? Because the Social Security and what's taxed there, I think people are always confused on it, and
yeah.
there's a whole tier as far as based off of your income. your total income in all essence is going to dictate how much of your Social Security is taxed. So if you're looking on the screen, 63,000 roughly is what their total gross Social Security income is. But Taylor's saying, and the law is that because of their income, 85% of it is taxable and added to their income for the year. So you still get a tax break, but it's not tax free.
Yes. Yep, exactly. So for their situation, they're going to their gross Social Security is around $63,000 for the year. They're going to pay tax on around $53,000 of their Social Security. So that's what gets added in for purposes of determining how much of their total income they're going to pay tax on this year. And then the last thing in this example is they had some prior losses from an investment account. You're eligible to take up to a $3,000 loss on your tax return that offsets other sources of income. So that means you're not paying tax on $3,000 of other sources of income. And if you have additional losses beyond the $3,000, then that carries forward to the next year. So that's what happened in their situation. Previous year, they had 50 plus $1,000 in losses. They're going to be able to use $3,000 of that loss to offset other income sources. The remaining loss will carry forward to 2026. So that's not new in the tax law. That's how it's been for a long time. So adding up all of their sources of income, we talked about the interest, dividends, the Social Security, IRA distributions, pensions. Totaling all that up, they have around $150,000 in total income, just below $150,000. So the standard deduction for this year, again, these people are both over the age of 65. Their standard deduction is going to be $34,700. So that is, again, a $1,500 increase from where it was prior to the update in the tax law. And all that means is of their total 150-ish thousand dollars in income, they don't have to pay tax on $34,700 of that income. So your standard deduction is an amount of income tax-free. And then the next line that we'll see here is the other update from the tax law, which is the other or senior deduction, where each person is eligible to take a $6,000 other deduction. So where they're married, we're seeing a $12,000 combined other deduction here. So the standard deduction gets subtracted out from total income. The $12,000 other deduction gets subtracted out from total income. And then the amount of income that they have to actually pay tax on is around $102,000 that we're estimating. So your taxable income, after subtracting out the standard deduction and any other deductions that you're eligible for, your taxable income is what gets plugged into the tax brackets. And that's where the first portion of income you pay a 10% rate, the next portion of income you pay a 12% rate. And then in this example that we're looking at, their final dollars of income land in the 22% bracket. So we would say their marginal tax rate is 22% because that's the final bracket that their income lands in. So when that calculation occurs where the first portion they're paying a 10% tax on, the next they're paying a 12, the final dollars they're paying 22, total amount of federal tax that we're estimating that they'll owe in this situation is $12,220 for 2025. And from their IRA distributions, from their Social Security, from their pensions, they have federal tax being withheld from all of those sources of income throughout the year. So each time they're getting an IRA distribution, they're also paying some federal tax at the same time. So that's taking care of the tax liability from those sources of income as they're receiving it throughout the year. In this situation, they're also paying quarterly estimated tax payments. So with the withholdings and the quarterly payments, we have that they will pay through the end of the year without any changes. They will pay $15,765 in federal tax. So if they owe $12,220, they pay throughout the year $15,765, then that means that at the time they file, they get a refund because they paid more than they owed. So they're going to get back around $3,500. So in this situation, what we talk to them about, and if anyone else was in a similar situation, what I would talk to them about is if they're comfortable with getting a $3,500 refund, if they like the sound of that, or if we want to look at reducing the remaining quarterly payments that they have for the year, or reducing some of the withholdings on their sources of income throughout the year as well to reduce the amount of the refund that they're expected to get. Because you're basically just giving the IRS $3,500 for them to give it back to you later when you file. So if you want to keep some of that beforehand to reduce the refund that is expected, then that's a conversation that we want to have to make sure whatever their preference is what we're working towards for this year too. So
Right. I think that refund conversation is always something that people have a preference on and prefer one or the other. But at the end of the day, the way that I think good tax strategy kind of runs is that in most cases, if you're getting a refund, that means, like you said, you overpaid, right? And you let the IRS hold on to some money. Some people are okay with that. They treat it as, hey, I'm getting some money back on a specific date and I'll spend that
yeah.
as for savings, right? And then the other is if I owe a lot, well, that means I didn't plan it properly for taxes. And so the goal, I think, for most is we want to try to get that to a place where it's break even. But
Yeah.
if you don't know tax law changes, then it's really hard to navigate that. So what if the 12,000 didn't exist? You know, I mean, do they go back to now having to write a check or kind of breaking even in this case?
Yeah, that's what I want to show next is what exactly the new tax law update means in terms of federal tax due in 2025. I will say though, too, before we leave this topic, we see all the time where the opposite happens and there ends up being a payment still owed at the time that they file. And then we still have the same conversation. Do we want to increase quarterly estimated tax payments? Do you want to increase the withholdings on your sources of income? Are there any changes that need to be made to reduce the amount of the payment owed? Or at least just be prepared to make that payment and know that it's coming. So it's not a surprise that you have to make a payment and you're scrambling to figure out where is that money going to come from when your tax preparer tells you whatever the final amount is. So, okay, so I'm going to scroll back up here. Again, remember the two changes in this situation is number one, a $1,500 increase in the standard deduction, and number two, a $12,000 other deduction. One thing that is important to know on this $12,000 other deduction is that there are some income limitations around this. So if your total income is greater than $150,000, if you're filing jointly, then your $12,000 other deduction starts to be reduced. As your income exceeds $150,000, you're not eligible for the full $12,000, you're eligible for less than $12,000. If your income goes over $250,000, you're not eligible for the other deduction at all. So the phase out range is between $150,000 to $250,000 filing jointly. If you're filing single, it's half of that. So $75,000 to $125,000.
Yeah, I think
So
that
because, yeah, go ahead.
sorry, Taylor. That's like the thing that came up in my meeting that we had together was, and I tell this all the time in financial planning and retirement planning, there's so many knobs that are intertwined. Like, you know,
Yep.
your how you're investing in a lot of cases is going to determine how you make your withdrawal or your income plan, which then leads into what your taxation is going to be from various accounts. And then you got to control your income so you don't run into Medicare or IRMA. But just within the tax code itself, there's a bunch of knobs. And that's what kind of led us into now a strategic decision with this client around, well, how much do we take from various sources so that we can maximize this new $12,000 deduction? And I think that's kind of where you were headed, right?
Yeah, if you have the ability to be flexible in your distributions, and if we can kind of play with the timing where maybe we get some of the distribution this year and some of the distribution next year, which in the example that Merce was talking about is kind of what we ended up deciding to not take the full distribution in 2025 to maximize that exactly the other deduction because that is now available. So it can lead to conversations around flexibility in distributions to reduce the goal is always reduce the amount of federal tax that you're paying. So when there's opportunity to do that, and it works out for everyone on both sides, for us and for whoever we're having the conversation with, then yeah, that's always what we're trying to do. Okay, so what I want to calculate is exactly what it means in terms of, like, we're getting the standard deduction, we're getting this other deduction, but what does that actually translate to in dollars saved? So an additional, in this example, again, $1,500 increase in the standard deduction, and they're going to be getting the full $12,000 other deduction. So that's another $13,500 total in income that they are not paying tax on this year compared to last year and prior tax law. So again, they're in the 22% marginal tax bracket. So if they had the $13,500, it would have been taxed at 22%. So that means in this situation, the new tax law updates, just from those changes with the standard deduction and the other deduction, it's reducing the amount of tax that they will pay this year by $2,970. And that's true for anyone in this situation, married, both over the age of 65, income below $150,000. The new tax law is saving you $2,970 in federal tax this year.
Yeah, I think what's so good about this is it just helps the person. We're doing this well ahead of next year. So this person now can go, okay, maybe I don't need to do the quarterly. If they really like a refund, then go ahead and make it and you'll get a refund. I don't understand why you would do that, but people could do that just so they feel good about getting the refund. But I'd rather keep the money in my bank account now versus giving it to the IRS and letting them give it back to me in next year sometime. So
Yeah.
this is just, I think, one tidbit. Obviously, there's going to be other things that we could talk about. So, for example, not that we're going to go into it now, but if I've got these higher deductions, it could be a conversation around, do I do a Roth conversion of some sort? Do I take and convert some money and just eat up that rebate or that refund rather by doing the Roth conversion? There's a lot of different things that we could do here in order to maximize this. But I think that for right now, we just wanted to share this one picture. I saw Taylor do it and I went, man, this is going to be a really good podcast and be able to walk people through it. So thank you very much, Taylor, for walking us all through it. And then as I say all the time, if you ever are listening to this and you go, man, I would love to be able to have a conversation around this, all you got to do is go to our website, go to the contact us page, submit your information, and we'll get in touch with you. But again, thank you all for listening. Thank you very much, Taylor. Thank you, Merce. Everybody have a great week. We'll talk to you again next Monday. We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.